Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. On the show today, we'll be discussing two topics. First, of course, because of the recent Fed rate cut, what the impact could be on different sectors. We'll discuss IT sector in particular, but that in just a bit. And that is something we'll be discussing with Taher Badshah, CIO at Invesco Mutual Fund. For now, we'll be speaking about overlapping that we see in mutual fund portfolios. There is a lot of it that we see. In fact, as per the data provided by Edelweiss Mutual Fund, in the large cap category, the overlap happens to the tune of around 60%. This is the top 5 funds by AUM, an average of that. That data should come up for you on the screen as well. For flexi caps, it's around 35%. For the mid caps, it's around 30%. And for the small caps, it's around 15%. But of course, that is an important data that we need to understand. Why does this happen and how can an investor work around it and speak to their own advisor and the mutual funds to make sure that the overlapping doesn't impact their returns? To discuss this and more, we have with us Niranjan Avasthi, the SVP and Head Product Marketing and Digital at Edelweiss Mutual Fund. Niranjan, good afternoon. Thank you so much for joining in. Always a pleasure speaking with you. Portfolio overlap just happens and sometimes the investors are not able to realize it. So tell us more, first up with an example, what exactly is a portfolio overlap? How does it happen for an investor?
First of all, thanks, Sonal, for having me. Always a delight to speak to you. This is an interesting topic that you have chosen today, portfolio overlap. People don't often talk about it. So what is portfolio overlap? It's basically, say, for instance, you have two large cap funds in your portfolio. Now, large cap funds by mandate had to invest almost 80%, minimum 80% of their portfolio in the top 100 stocks as per the SEBI scheme categorization guidelines. Now, if you have two schemes and out of these, say, on an average, they have 50, 60 stocks. And out of these 50, 60 stocks, these two portfolios have maybe 30 or 40 stocks in common, which means essentially almost 60% of the portfolio is overlapping with each other. And that is basically portfolio overlap, which means while you are holding two different funds, but the holdings, if you take the entire holdings of these two portfolios, 60% of them are same. Now, one thing is important to understand here, within the portfolio overlap, while the names of the stocks could be same, their weightages could be different. For instance, in the first large cap fund, the exposure to maybe Infosys, I'm not recommending the stock, but taking this as an example, is maybe 6.5%. And in the second large cap fund, the same exposure to Infosys is around 4.5%, which means the portfolio overlap between these two funds is 4.5% to Infosys. But mind you, in one fund, the portfolio manager is holding Infosys at a lower.
Okay, all right. That is what portfolio overlapping is. We'll do one thing. We will talk about this and more. We will just we'll just slip into a short break. We'll come back and we'll discuss more on the same. Welcome back. You're still tuned into MF Corner on CNBC-TV18. We were discussing overlapping of portfolios and why does it happen and what can an investor do about it. Niranjan Avasthi is back with us. Niranjan, you explained what a portfolio overlap really is. But why does it happen so often? And is it something that we see more in a particular category than the other?
Yeah, so portfolio overlap happen for multiple reasons, One of the most important reason is we have schemes categorization, and by regulation, each category of scheme has to invest a minimum of the portfolio position or portfolio portion into a certain asset class, and within that asset class into certain number of stocks. For instance, I was explaining a large cap fund. By mandate, large cap fund has to invest minimum 80% of its portfolio in the top 100 stock. Now imagine all large cap funds. There are more than 32, 33 large cap funds out there investing minimum 80% in the 100 stock universe. There will definitely be an overlap. So that is one reason. Second is if you're getting into a sector or a thematic fund. In sector and thematic fund, because the universe is narrow, obviously there will be limited number of opportunities where the fund managers can invest, and hence there is a portfolio overlap. So these are very common reason. If you see, overlap in large cap category is roughly around 60%, the data which we just saw. As you go down into maybe a flexi cap category, this gets reduced to maybe around 35 odd percent. If you go to mid cap category, it's around 30%. And if you go to small cap category, it is further reduced to 15%. What is the reason for that? The reason is the universe in mid cap is slightly wider than large cap. The universe in small cap is even more wider, and the universe in flexi cap is almost 500 stocks, and hence the portfolio overlap is slightly lower. However, the portfolio overlap between the two funds in this category could be around 30-35%. But the moment you add more funds, for instance, in a mid cap, between the top five funds, if you combine them, the overlap could be around 30-35%. But if you add two more funds, if there are four funds in the mid cap category in your portfolio, this overlap can be as high as 50% as well. Hence, two rules for overlap. Within the category, there will always be overlap, but the more number of funds that you have in that same category, the more will be the overlap. These are two thumb rules of portfolio overlap in a mutual fund portfolio.
Okay, so this is the reason why there would be overlaps in a mutual fund portfolio. So how can one identify the overlaps within different mutual funds? Do you do it on your own, or do you have to go to your mutual fund or your advisors who can tell you that, this is what's happening with your investments?
Well, definitely a lot of advisors and MFDs out there, they do this exercise. And when they create a portfolio, they definitely look at portfolio overlaps. So one, definitely, if you're not sure to do it yourself, how to do it yourself, take or seek advice or take help from MFDs. The second is you can look at the portfolio. There are certain tools available online. One of the website which usually I track is thefundu.com. You can just put two portfolios and see how the overlap is. If you want to do it yourself, you can compare the two portfolios on an Excel and simply see how many overlapping stocks are there. So these are a couple of tools that are available which can help you identify how the portfolio overlap is.
Okay, so some tools which are available easily for an investor. And see, once you've gone ahead, you've realized after using these tools that yes, there is an overlap which is more than what you should be having. How can one go ahead and reduce portfolio overlap in your holdings?
Yeah. So one, the golden rule is, of course, asset allocation. You don't put all your eggs into maybe one strategy of equity. Within equity also, you don't put everything in large cap or everything in mid cap. You can do a combination of various categories of scheme, maybe a large cap, mid cap, small cap. So different categories of scheme will not have very high overlaps within the portfolio. Second is, within the category, if you're choosing, it could be wise to choose one active fund and one passive fund instead of two active funds of a similar style. The third is, even if you're going into two funds or getting into two funds in the same category, you can choose one which has maybe a value orientation style, one which has a growth orientation style, one which is investing based on factors or multi-factors. So these couple of things will help you reduce the overlap. Also, if it's a narrower theme or if you're investing in a sector or a thematic fund, it is wise to choose only one fund within that sector, because sector or thematic funds usually have a narrower universe, and having two funds doesn't make any sense or doesn't make any difference from a diversification point of view. So these are a couple of things which you can do to avoid the portfolio overlap within your mutual fund portfolio.
Okay, so this is what we do with portfolio overlap. But there are some challenges that one would face as well, Niranjan. It's not that easy to just go ahead and be able to remove this, right? So what are some of the challenges an investor should keep in mind which could happen because of portfolio overlap?
So one of the challenges is over diversification, and if you if you have a portfolio that is very high in terms of overlap, definitely the returns that you make will be very close to the index. For instance, if you take the average return of a large cap or maybe a flexi cap fund in the universe, even if you take top five and for 3 years and 5 years, the returns are very close to benchmark. It is broadly, 20 to 30 basis point above or below the benchmark. So one major challenge or a drawback of over diversification or of having overlapping portfolio is your returns are completely linked to the market. You don't generate that much of alpha. That is one. Second is, you essentially you're not reducing your risk. You're diversifying, but your risks are similar to market, and probably in many cases your returns would be lower. Also, the third challenge is, if you have five funds in the same category, at any given point in time, you will have maybe two to three outperforming and two to three underperforming, which will always make you unhappy. So, it's always wise to have different style. In a cricketing parlance, if you have a cricket team with all Tendulkars in your team, it won't help. While Tendulkar is a very great player, it won't help. So you need a Dravid also, you need a Kohli also, you need a Bumrah also. So that's broadly, how you should go about creating a portfolio. And this is how you can reduce your challenges of portfolio overlap.
A team with all Tendulkars would be us living in an ideal world, right, Niranjan? And we are not living in an ideal world, but it makes sense. We need a team together with different skill sets to ensure your portfolio gives you the best returns possible for you. So thank you so much for your insights today. It was a pleasure speaking with you to understand how you can avoid portfolio overlaps, something investors know about, but maybe they do not act upon it so actively. So thanks a lot for joining in.
Thanks, Sonal.
Okay, all right. So that is about portfolio overlaps. But as promised, we have to discuss about the sectors that will be in focus on the back of the Fed rate cut. IT sector could be one of them. So let's discuss this and more with Taher Badshah, the CIO at Invesco Mutual Fund. Taher, good afternoon. Always a pleasure speaking with you. Thank you so much for joining in today. So, finally, the Fed rate cuts, they are away and they have come by. They've come through finally. Which are the sectors you think will benefit from the same?
So I think traditionally we've always seen that, in an environment where actually interest rates start trending downwards, I think some of the duration sectors, which are the long, tenure sectors, which typically are the growth sectors, such as technology, IT services, pharmaceuticals, consumer-related products. Those typically are the ones which generally attract relatively more investor interest. That's in contrast to what we see during the period of rising interest rates, and that's what we saw in the last perhaps 2.5 years, where value-oriented, sectors such as industrials, infrastructure-related, businesses actually saw relatively better momentum. So I think what we are probably likely to see is some of these, high growth sectors, which are typically generally associated with more longevity of growth, and relatively lesser cyclicality actually making a comeback.
Okay. So let's talk about specifically IT. How do the rate cuts in the US impact this space? You can explain for the viewers if this will be the one that will be in focus after this event that has happened.
I'd like to think so. We've seen that the technology sector actually just a few years ago, if you were to rewind back to pre-COVID or during the COVID times, actually the sector did very well, and that was a period when which coincided with falling interest rates and generally better liquidity conditions in the overall market. And obviously, it was also propelled by the important fundamental and underlying fact that there was rising technology adoption and adoption of IT services across the globe, given COVID conditions. And after which we've seen a reversal of that situation when interest rates have actually started to be on an upward trend over the last 2 years, and technology and IT services related businesses have actually taken a setback to some extent. I think that is once again likely to turn. So as we now sit on the cusp of a possible lower interest rate cycle or a reducing interest rate cycle, I think we should see once again a larger adoption of technology. It should lead to probably corporate budgets towards technology increasing. In any case, now the focus of the US government and the Fed in general is shifting away from inflation control to now, trying to boost growth, control labor-related conditions out there, etc. So I think we are therefore sitting on the possibility of overall technology spends once again reviving, corporate conditions essentially improving. What was probably held back by expectations that or fears that US might probably slip into a recession are no longer now on the radar, and interest rates are being looked upon. Falling interest rates are being looked upon reasonably positively. So I think we are likely to see resurgence in corporate spend towards IT. We are probably likely to see better commentaries out of Indian IT services companies, and over a period of time, I think over the next few quarters, that should manifest itself in the form of better stock performance as well.
Okay. So, Taher, it clearly means that good times are about to come for IT space. We've already seen a lot of these stocks run up. But from a mutual fund investor's perspective, if we talk about maybe an IT-focused fund or maybe a large-cap fund which has a lot of IT contribution to it, how much should the portfolio tilt towards IT be for an investor? Do you think one can go all out even at these levels?
So typically, this sector is considered to be has been considered to be a reasonably, defensive sector. It has got characteristics which are pretty healthy from the point of view of, less cyclicality. Balance sheets are reasonably robust. It's a low capital intensive business, so it has all those, advantages and positive features to support valuations. I think what we are betting on right now is clearly two components. One is the cyclical revival of IT services globally, and therefore India obviously stands to benefit out of that. And we are also simultaneously looking for, uh, you know, uh, more local technology adoption as well in the domestic context, especially from the point of view of technology influencing consumption, technology influencing the adoption of financial services, and last but not the least, even in some of the manufacturing-oriented sectors, whether it is, manufacturing of electronic products, or probably we are talking about semiconductors. We are also talking about a lot of new technology adoption as far as traditional sectors like power is concerned. So I think. The breadth of technology services is clearly rising. We are therefore looking at it as something which is relatively likely to be probably less cyclical compared to what it was, and not necessarily only dependent upon global IT services and their cycles. And therefore, to that extent, it is something which can probably be thought by investors as a more secular opportunity with very strong fundamental characteristics. I would like to think that many of the global indices generally have a reasonably large 20-25 odd percent representation in IT services alone, and even the Indian indices are somewhere in the vicinity of between 10 and 15% as far as the tech exposure is concerned. I would like to think that something like a 20 odd percent number in terms of allocation to this sector, which is fundamentally very sound and has that long-term play and durability, should turn out to be a reasonably decent allocation.
Okay, so that is something that an investor can look at. And interestingly, you spoke about the usage of IT getting there in every aspect of life. We were speaking to JP Morgan today as well, and they spoke about how AI is seen in semiconductors. We are seeing high industrial use, and technology in general is taking over all spheres of life. So good to see the impact that it could have, the Fed rate cuts on the sector itself. But Taher, I want to ask you about thematic funds. We have seen a big inflow coming in these sectors. Does it make sense in this case to look at thematic funds considering the flows we are seeing in a particular sector or the impact that we are seeing in a particular sector? And how does an investor decide when to get out of a thematic fund? Because it is quite cyclical.
So, I think what we see is more cyclicality when there are sector specific funds, and because sectors go through cycles, and we see market cycles across different kinds of sectors over different periods of time. I'm not sure whether thematic funds are as cyclical. We generally have a good number of ongoing themes in India, which we believe have a reasonably large durability quotient. And typically, they tend to do well over longer periods of time, especially if the promise of longer term earnings visibility and growth, which is associated with good thematic plays, manifests itself. So, what we are therefore, when we are talking about technology services and technology as an asset class, it is to that extent, therefore, becoming it's thematic for sure. But it, like as I said, is as it is becoming more and more widely adopted, it is influencing relatively more sectors. more businesses. I think we have better ability in terms of being able to look at a wider swath of businesses to which technology applies, and therefore that inherently reduces the cyclicality of such strategies. They are not necessarily dependent on one particular type of business, which, if at all, were to probably turn negative, it can meaningfully affect portfolios. For example, I would say sectors like pharmaceuticals or probably even consumption-oriented sectors. They are sector-specific funds, and you typically have one common construct of these kind of strategies. But what we are talking about here is not necessarily an IT services fund. What we are talking about is a technology oriented fund, and therefore it makes it a lot more easier for us to think about something which is relatively more secular in nature. So I don't think we will have to confront investors in general will have to confront with the possibility of timing themselves in and out of this product in the short to medium term. This is something which we're thinking a lot more long term.
Okay, so long term, of course, that's how long term investing parameters would work as well. But at these levels, Taher, we have seen some comeback in the IT space already. So how do valuations compare versus historical averages in this space?
So clearly, they are not cheap. But if I were to probably benchmark them to the valuation table, which is generally prevailing in the markets today at an aggregate level, I think they are at the lower end of their own valuation cycle. And generally, what we've observed is that some of these businesses, especially the IT services part of the business, typically does not require a very large delta in terms of growth for valuations to be justified out here. What we are trending at is, let's say, early single digit kind of growth in the sector as a whole over the last 4 to 6 quarters. If this were to probably elevate itself to more closer to double digit or higher single digits, I think that itself can probably lift valuations from where they are at current level. Look, in the height of the IT services sector boom, like as I mentioned, sometime in 2020 and 2021, we saw valuations go all the way up to plus 2.5 standard deviation. And where we are today is probably more in the vicinity of between 1.5. So expensive to some extent for sure, but not as expensive where we have seen them on earlier occasions. So I think there is room for valuations to also get re-rated. But more importantly, I think it'll be the delta of earnings, and alongside which, if you can probably construct a portfolio which is relatively more balanced between global as well as domestic opportunities, I think it should work out relatively better.
Okay, all right, Taher, we take that point. Thank you so much for joining in today with your insights on the IT space. It's been buzzing. So good to get some expert opinion on that as well. All right, with that, we will take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.